Do you want to eliminate that feeling that your money just doesn't go anywhere and you just can't seem to get ahead? Well, we do two things on this channel. One, help you get out of debt. Many different videos on how to do that, but every Friday we go over how you can preserve your wealth and beat inflation. Over time, it's well known that the dollar goes down in value. However, commodities like gold and silver, stock market, stocks, Dow Jones Industrial Average, S&P 500, they go up. That's what we're going to show you today. Then there's other new things like crypto. They go up. These things go up and to the right. Yeah, they have peaks and they have troughs, but over time, assets go up in value. Real estate, things like that. That's what the rich do. They put their money into assets. They don't hold on to dollars. That's a mistake that many people make. And because of it, you're not able to get ahead. So that's what we do every Friday. Let me show you what we do. We go over and compare holding dollars to all these other assets. We started back in February. And I'm going to have a video here at the very end that's important. And the last chart I'm going to show you is with respect to inflation, because what they show you in the media is a short time frame. It doesn't give you the big picture. And right now, in my opinion, you shouldn't be buying anything. Again, I'm not a financial advisor. My disclaimer is I'm a big dumb animal. Don't do what I do. Informational purposes only. But I'm going to show you that at the very end, and then a video I have that explains why you shouldn't. And I also have another one that I'll throw up there as well if you're interested about the real estate market in just 4 minutes and why you shouldn't buy a home at the moment. So the first thing we look at is, what if you just held on to dollars? Every month this comes out. You see, I show it every Friday. Savings, national rates are about 0.5%. Of course, you've seen some that'll give you a little more if you put more money in or that sort of thing, but a bank can change the saving rate at a drop of a hat. Then you go to something like a 3-month CD. Okay, 1.55 is the national average. Now you're locking up your money for 3 months. You get that rate for 3 months. That's not beating inflation. Neither of them are. What about treasuries from the government? 5.2. Not bad, but still barely beating inflation. So if you just hold on to dollars, they're going to go down in value. So let's look at some commodities. The commodities everyone's familiar with is gold, 2660. You can see how much this is up. Just compare it to this chart here that shows the prices back in February. Silver, 31.86. Back in February, it was just over $20. That's a 50% jump just this year. And I'm tracking this on purpose so you can see in real time that if you had started with us back in February, I've been doing this for years. 1, diversifying my assets, and 2, investing in assets. Now, some people do and don't believe in crypto. I happen to. I got a link below. I've got a show just about crypto. But we just look at the top 2 by market cap just to give you a general idea, because there are thousands of cryptos. Bitcoin, 66,000. Look at what it was back in February in the 40s. Ethereum, 2694. Both of these up nicely. We'll just call these 4 things commodities. If you had a little bit of money in these commodities, you could convert them back to dollars, because you can buy ETFs, which you can buy and sell in a brokerage account for gold, ETFs for silver. There's now ETFs from Bitcoin and ETFs for Ethereum. So you don't have to learn how to buy these things. You don't have to go buy physical gold. You don't have to figure out how to get a wallet for crypto and how to buy it. You can just go through Fidelity and purchase 4 different ETFs, and you'll have exposure to those 4 items. And when you want to turn them back into dollars, you go in, you click sell, done. It's that easy. So buying commodities is not as hard as people think. Now let's talk about the stock market. A lot of people like to look at Dow Jones, DJIA. It's 30 stocks. So here it is on a monthly basis. It's up 3%. But this is what I really want you to see. You can look at a 6-month up 7%. You can look at a 1 month up 1 year up 26%. You can buy, again, a fund that holds these 30 stocks for you. You don't have to go buy these 30 stocks. You can put money into a fund that just mimics and purchases these 30 on your behalf. 5-year, up 58%. Now, note, look at this huge drop. So we always want to have cash in an emergency savings that you need because it's transactional in case something goes wrong. You don't want to be forced to sell something when it's down, because look, assets do go down, but over time they go up. So look at all the peaks and troughs throughout here. Look at this completely sideways, but over a 5-year period of time, if you had money that you didn't need, you're saving for the future, it went from 26,000 to 42,000, a 58% jump. Max, they go back to the 1990 and earlier. The earliest is 1985. From 1985 till now, it's up 3,426%. Unbelievable. I'm older than this chart. So I could have been putting money in to a fund back then, which I didn't when I was a kid, and look what it would be worth today. That's the Dow Jones. Now, a broader one is the S&P 500. You'll read a lot of books, and a lot of people say most people, if they buy and sell their own stocks and they watch them and they track them, they do all these things, most people can't even beat the S&P 500 return over time. The yearly return, it might be somewhere 12 to 15%. It is hard to, as they say, beat the market. So here we are, 1 month, 2%. Last 6 months, 10%. So if you would put your dollars into this, inflation made your dollars worth less, maybe in the 90-cent range, but this would have put you in the $1.10 or so range. So your money would have gone up. And again, you can buy funds, buy it, sell it, and get in and out. 1 year, 34%. But look at this dip, probably scared people. Look at this dip, probably scared people. Kind of going sideways. It could take another correction. If you look at charts over time, the market does have pretty steep corrections every now and then. So again, you don't want to have money in that you might need in a month or 6 months or even a year if the market goes into a 12-month or 18-month or 2-year correction before it comes back out. So just note that. 5-year, 94%. What's the max on this chart? Back to 1996, about the same as the other one, 667%. That's a broader, because that's 500 different stocks. You may not have the capital to go buy 500 different stocks, but you can if you use one of these ETFs, and your money will be worth more than that. Okay, the other things I like to look at is the 2-year treasury. That's where you're buying. It's like a CD, but it's from the government. Let's just look at what it's paying, 3.58%. This changes over time, every day, every minute. 3.76 on the 10-year. Now that's good because you're getting more on the 10-year than you're getting on the 2-year. That makes sense. Now for a while you were getting more on the 2-year, and that's called an inversion. That's not good. But 2 reasons we look at the 10-year. We look at the 10-year because mortgage rates follow the 10-year. They're more directly correlated. Don't worry about the Fed rate as much. It matters, but not as much as the 10-year if you're looking at mortgage rates and where they're going. Here is why the inversion matters. Look at this chart. When the 2-year short term pays more, higher percentage return than the 10-year, that's odd, right? Because you would think you lock it up for a longer period of time. So that usually means something's not right in the market. And for the longest period of time, back to 2022, the 2-year's been paying more than the 10. It just popped out. Now we all might be thinking, that's great. Now the longer term pays you more. That makes sense. All right, look at this chart here. If we expand it out, these gray lines are bad times. GFC, other times we went into recessions and had issues. Notice that right before each one, inverted, came out, bad time. Inverted, came out, bad time. Inverted, came out, bad time. Here we are over here, inverted for a long time, came out, uh-oh. We don't know what that means, but it may not be good. So what am I doing? What is my opinion? Like I said, my opinion is don't be buying things right now. Here's why. Here's inflation. Inflation over the last year, every month you can see the numbers, and they're going to say the Fed wants to get it under 2%. And the media and everyone will tell you, well, look, inflation's down, that's great. But then you're thinking to yourself, yeah, but everything I'm looking at, cars, groceries, everything is still more expensive. Why does that make sense? The media is telling me everything's great. Here's why. If you look at a 3-year, but let's look at a 5-year. Back in 2020, 2021, we had almost 0% inflation at a time and everything under 2 in the 1s, etc. Then we had this period here where things shot up to about 9%. So if you were to draw a line from here across and circle it, that inflation is still there. That's why the prices for everything are still high. You don't see that on a 1-year chart. On a 1-year, it's still high, 3, 4, still more than it was in the past. But in order for prices to come down, everyone said, oh, inflation's not bad. No, it's still bad because this hasn't gone away. It needs to come down to 0 or even negative to wipe out some of these huge gains. So look at these 2 videos. I suggest you watch both. But the most recent one I did just the other day says don't purchase anything, here's why. And it walks you through this inflation chart. The other one, don't purchase a home right now, here's why. And that's an article that was very well done. And in 4 minutes, you'll see why. Pick either of those videos. I think they're worth watching. Have a great day. I hope this was helpful. Thanks for watching.